All right, so today I'm going to tackle a lot of questions that we've received about interest rates, in particular, what we might see interest rates do over the course of this year, as that topic has gotten a lot more attention as we've seen interest rates in 2022 move up a good bit from what had been very long-term lows over a very extended period of time. And that's gotten investors' attention, understandably, with those rate increases and it being telegraphed that likely more interest rate increases to come from the Federal Reserve and likely other central banks around the world over the course of this year. So let's start with why are short-term interest rates expected to increase? So they are expected to increase, and the primary motive for doing that, no doubt, is to try to get inflation more under control. We all know we've been through a period of relatively high inflation in most countries. And one of the mechanisms that central banks have to try to keep that inflation rate or get it back down to lower levels is to increase that short-term interest rate, which flows through the economy and generally will slow down the propensity that folks have to borrow money, and tends to therefore bring down inflation. The other question that we've seen come in is how much are rates expected to increase? And there's a good bit to talk about here, so I wanted to spend some time here. So for short-term interest rates, which you have to keep in mind, that's really all that the Federal Reserve can directly control. That's expected to increase as of today here in late March, early April 2022 of about 1.5% to 2% over the balance of the year. That's a pretty big move in short-term rates, no doubt, but important to understand that is kind of known to the marketplace at this point. So be very careful in terms of trying to think, well, that means that I need to do A, B, C, or D, or make big changes to your portfolio, because again, that's known information to the market at this point. Other thing that I like to point out there that's really important to understand from an investment perspective is that even though we have a very good clue as to what short-term interest rates are going to do, that doesn't mean the exact same thing will happen to longer-term interest rates. So for example, we don't know what will happen, but we could see those short-term rate increases like we talked about, but longer-term rates, say a mortgage rate or longer-term rate that the government borrows at, maybe stay where it is, go down, maybe go up as well. So very difficult to predict what will happen to some of those other rates out there. So again, just a caution against trying to predict other things that might happen as a result of those rate increases. Now, how should investors think about all this? So we'd say, by and large, as it usually does, it probably makes sense to continue doing what you're currently doing. From a fixed income perspective, we generally believe that in all environments that short to intermediate term fixed income investments are better than longer. So that naturally gives you some protection against rates moving in unexpected ways. And then the other thing that I like to emphasize here is that all else equal, over time at least, higher interest rates are better than lower interest rates. If you're investing in fixed income, part of the reason you're investing in fixed income is to earn a return, and those returns are generally going to be higher at higher interest rates compared to lower. So there is a silver lining here to think about from an investment perspective. Hopefully that's helpful. If you have additional questions, feel free to reach out to your advisor. Click the link in the description. We're happy to take and eventually tackle any other questions that come through those channels. Thanks.